Hi, I'm Peter Rose, founder of Longwood Currency Trading, and I thought I'd take this opportunity. It's early February of 2023. I've done my tax return documents for this year, and also as a result of that, I've run my trading metrics over the course of the year, and I thought I'd share those because a lot of folks that I talk with say, well, are you really doing this, or what's happening? Trading metrics are, well, I track about 15 different types of metrics. My largest win, how many wins in a row I've had versus how many losses in a row I've had, what's my greatest loss, what's the average duration of a trade, and all that sort of stuff. But there are 4 metrics that I talk about pretty consistently in the videos that I do and on my blog posts at longwoodcurrencytrading.com if you're interested in reading about some of this stuff. I haven't really done any blogs in the last year. There are about 50 entries on there, but I tend to do better through the video. I get more response through the videos. In any event, there are 4 trading metrics that I think are absolutely critical, particularly for the mid-beginner trader. And I say mid-beginner trader because until you develop it isn't the metrics that create the good trading, it's the good trading that create the metrics. So you have to figure out how to trade, and then the metrics come into play in order to help you improve that trading or show you where you're wrong. But you do have to have consistent results before any metric is going to do you any good. You can't run 50 trades out, 50 positions out, and go, oh, I'm a 90% winner in this, and I've got a $10,000 per trade expectation. It doesn't work that way. You have to deal with a large sample size of trades, and large would be at least 100. And in the beginning, since you really don't know what you're doing, and it takes you a while to validate within your own trading that, oh, I'm being fairly consistent right now, because until you get consistent, you don't have any metrics. You really don't. And so you have to be really careful with this stuff. And I say, oh, you need to have about 300 trades, positions on closed positions before you can really develop any true metrics. And that's kind of difficult for most folks. It takes a long time, and you're certainly not going to get 300 trades if you're a position or long-term trader. I think from a retail standpoint, if you want to be an investor, you do that in stocks, and you do your preliminary value research up front. You buy the stock and you hold it for 10 years. If you're doing real estate, you do the same thing. When you're going to trade options or stocks or commodities, and particularly currencies, I don't think there's a long-term thing there for you. In the old days, not too long ago, 10, 15 years ago, 20 years ago, there were these long trends that were not interrupted by these massive pullbacks that we have today. There are economic reasons why that happens. It's not magic. You can hear, like, it's got snow falling off the roof. Oh God, it was 30 below yesterday. Yeah, it's pretty cold today. Anyway, the object of the metrics is to tell you more about the trading methodology that you're using. Is it as successful as you simply saying, oh gee, I set out to make 50 bucks a day or $5,000 a day, whatever it happens to be, whatever your bank size allows you to do that, and I make 50 bucks a day just about every day that I trade. I average about 50 bucks a day. There's a consistency there. You do some math to figure that out. Not just your winning days, 50 bucks, because you could be losing 200 on your losing days, and you could have a low win-loss ratio, and you're screwed. But once you get feeling pretty good about your process, however long that takes you, maybe you can do it in 50 trades. I don't know. Some people come into it relatively successfully to start with. 99% of the people come in with losses in the beginning. 90% lose their whole account in the first 90 days. They lose 90% of the traders lose 90% of their money in 90 days. That's the statistic over 43 million transactions documented at a major Forex broker many years ago. So there's a conundrum here. How long do you need to trade in order to get valid metrics? And once you get the valid metrics, they help you make your trading better, so the metrics may change a little bit. Although not dramatically until a few things happen. And that, in fact, is what I'm discovering about my metrics this year. The previous year, I was about a 70-30 trader. And doing okay. I mean, I was pretty consistent up until the end of 2021, where I did a long-term trade and I got caught at the end of the year, and if I held the big loss over into the following year, I'd be paying taxes on money that I'd lost. It was stupid, so I had to close it out, and it took a huge hit. It took well, it took about 60%, 70% of the money that I had made that year. Left me with a nice return, but you know, that's the 2022 metrics that we're going to be talking about. The 2021 was about a 70-30 win to loss. So in looking at this year's metrics, I'm looking at 4 critical metrics. I'm getting back to that. I mentioned that. Win to loss ratio, your average win value, what I call your per trade expectation value, and your RAR, which is the return against risk. Now, the win to loss ratio is how many times you win versus how many times you lose. That ratio of itself isn't valid. I could be a 90-10 trader, 90% win and 10% loss, but every time I win $5, and every time I lose $100. So by itself, it's not really valid. If the rest of the metrics are good, then the win-to-loss ratio is valid. So there's win-to-loss ratio. The average win, you take all the winning trades that you've had, and you divide them by the number of winning trades, and you come up with a number. And that number is really important in calculating all kinds of different cool trading parameters that you can apply to your trading. For example, how far apart should your price be before you stage in the next lot? How many lots should you stage? What's your expectation of doing that? How do you calculate that, by the way? And so that average win value comes into play as not only as a metric that you can use for other analysis and calculations on your trading performance, but it also stabilizes the validity of your win-to-loss ratio, okay? Win-to-loss ratio, average win value. Next is per trade expectation value. You take the total net winnings over the course of the year, including your carry interest results. You take those winnings and you divide them by the total number of trades that you took, total number of closed positions, and you get a number. And that number means that whether because I'm consistent, again, this is consistency, it doesn't matter what my win-to-loss ratio is at that point when you have a good per trade expectation value, because it means that whenever you close a position, on average, it's going to be X dollars. It could be $50 or it could be $10 or whatever. And that number comes into your confidence building and that you say, what it does is it enables you to cut a bad trade off when it's running. If you don't have certain ideas of how you're trading in the long run, then you're desperate to hang on to that trade. You did all this research and this is a great trade and it goes in your favor, and all of a sudden it turns around and goes against you, and you're I'm really convinced that this is the way that it should go, and it goes further against you, and it goes further against you, it goes further against you, and you keep hoping that it's going to come back. That's a problem that I have. It isn't because I'm emotionally damaged, but I spent 40 years in real estate, where you don't get out of a piece of real estate just because it sucks. Because it only sucks now. In 3 or 4 years, it's going to be better. Half of the real estate that I bought sucked badly, but I knew I could turn it around. You can't turn a currency trade around, guys. So when it goes bad, you got to get out. Well, it's very difficult for me. I mean, that's a situation that I'm dealing with, and it's changed my metrics, actually, and I'll get into that a little bit later. But your per trade expectation value gives you confidence that when the trade goes against you, you go, I'm going to get out. Because the loss doesn't matter, because you're getting out with a small loss. Because you're looking at a year's worth of trading, last year, for example. You say, I've got good win to loss, I'm going to come out of this okay. My average closed position is worth $50 to me. I'm trading a 1 lot, maybe. Or a 2 lot. It's tough to get. Well, $50. Yeah, $50. You could do that on a 1 lot. That's 5 pips, right? So I know that my average win is $50, or my average trade is $50, whether it's a winner or a loser. So although I might lose $100 on that trade, I know that in the long run it'll spread out, and that closed position will actually be worth $50 positive to me, because my statistics tell me that my per trade expectation is $50. So whether I'm winning or I'm losing, that event is putting $50 in my pocket. I mean, it's just a powerful way of looking at your calculation or your trading. The final metric is RAR, return against risk, not return against bank. A lot of people do that, and I feel it's an incorrect way. It's very difficult if you're not taking good notes or know how to extrapolate the information from your broker transaction report at the end of the year to be able to calculate this, but you have to do it. You cannot say, I've got a $30,000 account, and at the end of the year I made $3,000, so I made 10%. Because, or I made $300. I made 1% against that $30,000 account. Because if you're only trading one full lot against the 3, the 10,000 versus the 3, then you didn't risk 30. You risk 10,000 on any trade. If I make a trade, and that's my way of calculating, that's what keeps things simple. If I'm trading one full lot, right, it's a $10,000 account. So that if I make $5, $50 on that, or let's say I make $10 against it, I've made 1 pip on a $10,000 lot. I mean, it's easy to figure out the percentage gains that you made and all that sort of stuff. If I have $20,000 in the account, but I only trade 10, and I make a certain amount of money, do I then divide that amount of money by my $20,000 bank or by my risk, which was the $10,000? Well, you divide it by the $10,000 because it's just one trade. But if you're doing that all the time, and your bank size changes because you're adding money in and you're taking money out to go out to dinner and all that other stuff, how do you possibly determine what your return against your risk is? when I buy a piece of real estate, I go in there, let's say it's a $100,000 property. I put $10,000 into it. The property appreciates $10,000. Did I make 10% on my money because the property went from 100,000 to 10,000, 110,000? No, I made 100% on my money because I put $10,000 up. The property is now worth 110,000. I made 100% on my money. If I had 5 properties and I take the value of all those properties and I say, oh, I made X amount of dollars over all of them, then I can say, well, okay, then my return against my portfolio is this. But in currency trading, you might want to say, I want to separate out how well I'm doing against the pound dollar versus how well I'm doing against the Aussie yen, right? Because they're different. There's different price actions involved. There's different economies involved. You may be trading them at different times and therefore taking advantage of different types of volatility. You'd like to know, how do I trade in a more volatile situation as opposed to trading in a non-volatile one? Sometimes the spread is higher on certain pairs than on other pairs. How do I correlate those together? And so all of my metrics are done on a per pair basis, not on a portfolio basis. And they're also done on a risk basis, not on a portfolio basis. If I was a hedge fund and I had hundreds of different currencies and I was trading them all and I had millions of dollars involved, then doing what I'm doing is not worthwhile because I'm constantly involved in the thing, and then I'd have to treat it as a portfolio. But I don't do that in the manner that I'm trading because that doesn't give me the information as to how well I'm trading. So the RAR is the return against risk. So if I have a $100,000 portfolio, but this particular trade, I only traded 30 lots and I make, 3 lots on that, $30,000, and I make $300, I'm not dividing that by the $100,000 in my bank. I'm dividing it by the $30,000 that I actually used in this particular closed position. So that's the difference between what people would generally call an ROI as opposed to what I'm calling an RAR, which is a return against my risk. And so let's go back through those. I've got a win-to-loss ratio that tells me the number of wins to losses. I've got an average win value, which tells me take the total number of wins that I have, divide that by the number of the value of the total number of wins divided by the number of wins to get the average win value. I have a per trade expectation value, and I have an RAR, return against risk. So in the 2022 metrics, I had 577 transactions and 127 positions, closed positions, which is different than my normal trading. I would normally have 300 or 400 closed positions. The reason I had 127 was because I had too many carry trades. And so that just jumps out at me. Why did that change? And of all the losing positions that I had, 90% of those were carries. That's an important thing for me to know. Regardless of the fact that my win-to-loss ratio came out very high at 75-25. Last year it was 70-30. I think 75-25 is high because some of the carry trades that I had that I carried from weeks became winners, but they were massive losses until the economic situations in the countries caught up and I was able to make a profit. So the losers turned into winners. I think that value is probably a little higher than I would like to admit. And so that's important information for me. I do not consider myself a 75-25 trader from a win-to-loss standpoint. My average win value, by the way, is inordinately high in comparison to how I really did. And the reason for that is because I carried too many of the losing trades over a long enough period of time where they became winners. And generally, when they turned around and became winners, there was a spike or a pin bar or something that gave me a large payout. Where in the initial thing, I might have been looking for $1,000 because I'd held the thing for so long, I was aggravated at it. I just said, "Oh well, I don't care. I've had this loss before. I'm convinced." I'm convinced it's going to win, and I'm going to let the thing run. And so instead of making $1,000, I make $5,000. So there's a skewing of my average win value because of an error in the way that I am conducting those carry trades and letting a lot of them run in negative distance where I should really cut them loose. So although I've got a great average win value, I'm very skeptical of that average win value. And in fact, when you compare the average win value with my per trade expectation value, it's enormous. The difference is enormous because the per trade expectation value is very low because I had so many really big losers. I mean, I had, $60,000 loss at the end of 2022. I had a bigger loss than that, but let's just say it was really big. And so now you take all the positions that I had and you divide the values of that, and you divide that by the number of positions, and the number comes out very, very small. No shit. So I don't have any confidence in my per trade expectation value. The thing that does affect me is the return against risk, which turned out to be 46%, and that is a valid number for the year's trading. It's particularly interesting because the first 3 or 4 or 5 months of the year I was trading 3 to 6, maybe 8 lots, something like that. And it was only the last couple of months of the year when I got up into trading 25 lots, 20 lots, in that range and more. But it was a short time where a lot of the money that I made came in. There were 2 months toward the end of the year that I had $30,000 net profits for those 2 months, each month, so $60,000. There was another, I did that 3 times during the year, 3 $30,000 months. But they were happening as my bank size increased, so you would expect that. You would expect a monthly win rate from 4,000 or 6,000 to 10, 15, 20,000 to be pretty normal as you increase the size of the bank. The thing that screws everything up is those carry trades that I had that I held too long. But the 46% return against risk is a valid process. I take the average of all the positions that I made. In other words, if I had one position that I had 3 full lots trade, that's $30,000. If I did another position and it was $100,000, that was did a 10 lot, then now I had 130,000, and then I divide that by 2, and that's my average position size. It'd be about $65,000, right? And so that return against risk is valid on a per trade basis, but it's also valid at the end of the year, and more so valid at the end of the year because it gives you a good idea of your overall trading performance. And I don't compound the way that most folks do. I don't get, 10,000. I have $10,000 in my bank and I trade 1 full lot. I have $10,500 in my account and I trade 1.1 lots. I don't do that. I trade by the numbers of $10,000 that I have, and so when I go from when I went from trading 3 lots, I mean, I had 6 figures in my account the whole year, but I only traded 3 lots because I understand there's a way that you increase the size of the bank that you trade. You see a lot of these guys out there that are trading these small accounts. Oh, I took $50 and I ran it to 200, or I took a $100 account and I ran it to 500. Okay, take a $100,000 account and run that to $500,000. You're not going to fucking do that. You're not. So there are mathematical reasons for that, and there are constraints on you when you're doing that. So if you want to piddle around with mini lots and you want to trade 1 full lot or something, yeah, you'll be able to make great returns on that because you have nothing at risk. That's great. So, but what are you going to do? Well, I mean, you're not going to make life-altering money on a $5,000 account or a $500 account. I mean, you're not. If you did 100% on your bank at a 5,000 bank trading 5 minis, you'd make $5,000 a year. It's a great percentage return. It's 100% return on your money. But what's $5,000 going to do for you? And the risks that you take, now you got 10,000. Are you going to try that same shit that you did with the 5? What if you lose 5,000 then? Now you've lost 50% of your bank. It'll take you 100% to make that back, just to get the break even. And you're going to make 200% in order to make that same thing happen the next time. Look, I got a degree in physics, almost a minor in math, and I was in real estate investment for 40 years. I think I know a little bit about this. You can bitch at me for the way I trade and present stuff and whatever, but I know what's going on. And if you think you're going to run your $500 or your $5,000 to job independence, you're out of you're not. So the fact that despite my idiocy of hanging on to these losing trades and taking large losses, I still had the skill to make a 46% return against my average risk over the year. And that's somebody's salary, okay, for the year. So I'm pleased with that. I'm aggravated because before I got into that really bad trade at the end of 2022 that I've talked about, and you'll have to go back in my videos and just read the titles that are on the videos, and they'll tell you all about the sad story of losing all that money. But right before I took that loss, I said, I'm up 91% against my risk. That's where, and I'd made well over $100,000. I was up 91% against my risk. And I ended up at the end of the year, even taking all those losses and things, still 46%. So, you know, there's a good win-to-loss ratio, 75-25, that I have to kind of discount. My average win it's just skewed too high. My per-trade expectation value, I don't have any faith in that because I was stupid and took the losses. So the return against risk is heartening for me because even with massive stupidity, and again, I'm not stupid. I know how to trade, and it's very clear to me that it's going to be almost impossible for me under the methodology that I was using in 2022 to overcome the survival risk management that I developed over 40 years of trading real estate, investing in real estate. It's ingrained in me. I mean, it's like if you come up quickly on me, I'm going to move back like that. From 50 years of martial arts training, that's just what's going to happen. You get into my space, and you can get poked in the chest because I don't want you in my face, and I don't care. I'm sorry about that. I mean, when I was in college and I was taking karate, we were visiting we were visiting the women's dorm with some friends of ours. A few of the guys came over, and we were visiting some friends of ours that we knew. And I was standing in the doorway like this, and this girl came down the hall, and she comes in and she grabbed me around the arms. I had my arms down like this. She grabbed me around the arms, give me a hug, and I went bang, and down she goes. I was so sorry, but she understood, because I was wound up pretty tight, and I was a black belt in karate, and I know, what are you going to do? You can't sneak up on somebody like that. And so you got 40 years of a methodology that I retired a millionaire because of that real estate investing process that I went through. I never lost money in real estate. I was a mortgage broker and a mortgage lender at one point for a short period of time, about a year. I never lost a mortgage deal. I had broker's licenses. I had mortgage lending licenses and all that stuff. I knew what I was doing. But that knowing what you're doing builds up the risk management. That's what the risk management is all about. And so it's very hard for me to do this in real-time trading. You know, I've only really been trading real-time with a large amount of money since about 2018-19, something like that. That's when I lost the $40,000 and went, whoa, wait a minute, this isn't right. I should be able to do something better. And then the next year I was up 31% on my bank after that. I figured it out, and now 2022 I'm up 46% against my risk. So that's because of these metrics coming out, they're not useless, they're vital to me to say, wait a minute, you're kind of upside down here. Look at how much better you would do if you did this, and if you did this, and if you did this. And there are three things. What I did, as you will know if you've been watching my videos, is toward the end of 2022, I started developing some computer applications, simulation applications against different ways of price action, staging, in, out, different processes of risk management based on several different variables. Most of the programs that I'm working on have 3 to 4 variables that I try to vary. So I've written about 4 different applications because I don't want to vary more than about 3 variables at a time in order to develop any sense of whether the application of the simulation is doing any good. Because the complexity of the end results comes back as a spaghetti mess of information, data, and it's very hard to interpret. So rather than that, I'll write an application that deals with 2 or 3 metric changes and develop that. Then I'll use the information from that in the next application and build the app for that. So that's what I've done. And I've got the process solved, and that's what I'll be doing this year. But the motivation for writing some of those applications was I ran some of these my statistics, the win to loss, average win per trade, and RAR, kind of on a pencil on a whiteboard, just looking at my transaction report and saying, well, it looks like I've averaged about X number of lots for these trades, and it looks like that I have some. I got a general idea of what my average was. And in fact, my ballpark eyeball averaging over the times when I was doing this analysis came out to be pretty close to what the average, the overall bank size that I had behind the trades that I was using on an average basis. So I was pretty close to that. So I had a pretty good idea of what was happening, and I knew why it was happening because I've said that during many of the videos. I'm encumbered by this risk management process in real estate. So I'm looking for ways to do that. It's easy for me to teach. The folks that I have that listen to me go, oh, is it that easy? I go, yeah, it's that easy. You just can't have 40 years of real estate behind you. It's easy for someone without my disposition toward the risk management from real estate. It's easy for someone else to look at a process or a plan that I lay out, whether that's in a course or consulting. So they go, oh, okay, I see how that would work, and I can do that because it's really simple. But the problem with me is, yes, it's really simple to understand, but from an emotional core thing, it's proven to be catastrophic in my inability to cut those losing trades. So what I'm seeing in my yearly metrics results is that I have been unsuccessful in forcing the solution to that. And I'm now finishing up those simulation applications that I've been working on. I just finished the last one last week, and I'm looking at those. And now I'm in a position where I'm building rules that will make it easy for me to cut the real estate risk management out, because I'll have a different view of the risk management than I had. So I think this next year, 2023, will be really interesting to see if I'm able to, because you can't force against nature. You can't force against your intuitive way that you think. I mean, someone jumps into my space from a karate standpoint, you're just going to get punched. The way that we mitigate that is simply to do that. I'm gonna pop you in your chest, and I'm just going to take that quick step back. I mean, if you charge me, I'm just going to lay you down. But the immediate response, for example, when that girl grabbed me back in college from behind and I dropped her, those were the early days of my karate training. And you get wired up, and you're in competition, and you're doing all that stuff, and so somebody does something, bang, and you just react that way. But as you become more and more and more experienced, you're not worried about somebody grabbing you. You know, I had a situation just 2 years after that where a bunch of guys thought they were going to have some fun with me, and they were going to drag me over to the shower and put me in the shower at the college dorm. I don't think so. Well, there could have been some very hurt people if they would have tried that, a year before or whatever. But in the process, you learn your risk management in a different way. And so they didn't get me in the shower, but I was able to convince them that that was not the thing that they wanted to do with me. Nobody got hurt. But they did not get me in the shower. And so that's all I have to do in bringing that same process of risk management in martial arts, and what I developed through the real estate investment. I just need to manage that in the same way and change it. Too often we get looking at the shiny object. Oh, geez, if I hang on to this trade, I could make X amount of dollars. Well, when the trade starts to go against you, the X amount of dollar target goes away too. You can't say, oh, it'll come back, and then I'll make this. No. You got to say, well, what's a reasonable profit target? Does this thing look like it's going to retrace a third of that and then come back on its way? Or what sort of training are you going to need to have in order, even if you don't have the real estate behind you, in order to rationally develop that entry analysis process? I spend a lot of my time in entry analysis, not only in this video stuff, but in the coursework and when I'm talking with people. Because if you can't get out of the entry analysis and get into the position management phase of the trading life cycle, you're screwed. You got nothing to manage. And so it's so very difficult. It's easy to enter the trade. It's easy to say, oh, I'm ready to go in. That's my setup. That's just stupid. The setup is such an overworked term. It works for some people, but it's not the setup the way that they're teaching it, because you can't duplicate that. I'm just telling you that. I've got a lot of experience in this stuff, and you can't. You have to be taught how to trade, not how to trade setups. That's just the way that it is. In any event, my 2022 metrics, I hope I've entertained you with that. They mean absolutely nothing to you. As it turns out, they mean nothing to me as far as how well I'm doing, but they have totally confirmed for me where those real weaknesses are and what I'm capable of doing if I don't make a couple of errors in the way that I'm evaluating during that entry analysis stage of the life cycle of a currency pair, evaluating that in a more correct manner. And in fact, the solution to that has come in this last simulation that I've done, and it isn't that the solution came out of having to write a computer simulation. It's simply a statement that I've made many times, is that in currencies you can't trade intuitively the way that you would intuitively think until you've traded currencies and understand how to intuitively look at that price action, because it's different than how you would manage risk in any other environment. There are many reasons for that. I'm not going to get into that right now because that's not what the video is about. The video, and it's not about my metrics, but it's the importance for you as a trader, whether that's as a beginner trader or if you're in the low five-figure account size trading. This is stuff that you've got to not only know how to calculate, but you've got to know the ramifications of what the numbers mean to you. I talk to people all the time, and they say, oh, I'm a such and such trader, and I did this and I did that. And I go, what about this? And they go, well, I don't know. And I go, well, that's what your metrics are supposed to tell you. And the reason that they don't tell you that is because of this or this or this or whatever. And it takes a while to get somebody back on track because, you know, as traders, we get so convinced that what we're doing is good when we win, and we propagate that. And we don't really learn from the losers. You don't learn from the winners. You only learn from the losers. And so the metrics are a way of evaluating those losses. Yeah, that's really what the metrics are good for. Anyway, I hope you've enjoyed this. If you've got any thoughts about it, send me an email. I appreciate you subscribing to the channel and also, commenting. But for real communication with me, email me. I don't DM anybody. I'm not on any other platforms. Be very careful about responding to comments. They have my little picture there on them because it may not be me. There's a lot of false stuff going on video land here. Be very careful about who you think you're communicating with. I have one email address and one website and just one social media platform, and that's all I do. So if you want to communicate with me, the best way is through the email address that's listed on my channel. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.